Behind the billions. Wall Street is running a massive, multi-trillion-dollar illusion. Every single day, thousands of highly paid fund managers boast about their complex financial models. They claim they are analyzing the global markets, using supercomputers and incomprehensible algorithms. And in exchange for this complexity, they take billions of dollars in fees from your hard-earned money. They want you to believe that. Investing in the stock market is a sacred, highly exclusive art. An art that ordinary people are simply too foolish to understand. But today, we're going to look at one man who laughed at all this arrogance and completely shattered the system. His name is Joel Greenblatt. He is the founder of Gotham Capital and a legendary professor at Columbia Business School. In 1985, Greenblatt founded a hedge fund called Gotham Capital. Over the next 20 years, his fund achieved an unbelievable annualized return of 40%. Let that number sink in for a moment. An annualized return of 40%, sustained for over 2 decades. To put this into perspective, if you had invested just $10,000 with Joel Greenblatt in 1985, your money would have grown to over $8.3 million 20 years later. This performance did not just beat the market, it absolutely demolished it. His 40% return was nearly double the annualized return of Warren Buffett, the greatest investor of all time. So, what was his secret? To break the back of Wall Street, Joel Greenblatt did not use supercomputers or complex economic theories. He used just 2 simple numbers. 2 numbers that any middle school student with a basic calculator can find in less than 5 minutes. He called this ridiculously simple strategy the magic formula. Greenblatt defined the absolute essence of successful, investing in one deceptively simple sentence: buying good companies at cheap prices. It sounds incredibly obvious, but while everyone else paid lip service to this idea, Greenblatt was the only one who figured out how to mathematically isolate it, using just 2 metrics. The first metric in his formula is return on capital, or ROC. This is the single number that proves whether a company is actually a good business. Think of it this way. Imagine you want to buy a local business, and you have 2 options. The first option is a bakery that requires $100,000 of capital to set up, and it generates $5,000 in profit every year. That is a 5% return on your capital. The second option is a laundromat that also requires $100,000 to set up, but it generates $50,000 in profit every year. That is a 50% return on your capital. Even though both businesses cost the same to start, the laundromat is an infinitely better business because it uses capital with extreme efficiency. This is exactly what return on capital measures. It tells you how much cash a company can squeeze out of every single dollar they invest in their business. The second metric in the magic formula is earnings yield. This is the number that tells you if a company is selling at a cheap price. In the stock market, even the most magnificent company can be a terrible investment if you pay too much for it. If you buy a great company when its stock price is trading at a hyped-up premium, you are guaranteeing that your future returns will be mediocre. Earnings yield is the inverse of the famous price-to-earnings, or PE ratio. It essentially asks, if you were to buy the entire company today, what percentage of your purchase price would the company generate in operating profit over the next year? If a company is valued at $100 million and it makes $10 million in profit, its earnings yield is 10%. The higher this percentage, the cheaper the stock is relative to the actual cash it generates. Joel Greenblatt's genius was in systematically, mechanically, and ruthlessly combining these 2 numbers. Here is exactly how the magic formula protocol is executed. First, you gather a list of the largest 3,000 companies in the stock market. Then you rank all 3,000 companies based on their return on capital. The company with the highest efficiency gets ranked number 1, and the worst gets ranked number 3,000. Next, you rank those same 3,000 companies based on their earnings yield. The cheapest company relative to its earnings gets ranked number 1, and the most expensive gets ranked number 3,000. Finally, you add those 2 ranks together for each company to get a combined score. For example, if a company is ranked 10th in efficiency and 20th in cheapness, its combined score is 30. You then sort the entire list by this combined score and buy the top 30 companies. You buy them in equal dollar amounts without asking any questions. You hold on to these 30 stocks for exactly 1 year. After precisely 365 days, you sell all 30 of them. You run the exact same formula again. Get a fresh list of the top 30 companies, buy them, and hold them for another year. You repeat this mechanical cycle year after year. with zero emotional input and zero hesitation. This mindless, repetitive exercise was the exact mechanism that produced a 40% annual return. But here is where the story gets deeply fascinating. If this formula is so simple, why aren't the genius hedge fund managers on Wall Street using it? To answer this, Greenblatt exposes the dark, cowardly underbelly of modern institutional finance. The barrier to using the magic formula is not intellectual. It is psychological, and it is rooted in the structural corruption of how Wall Street professionals are paid. While the magic formula produces spectacular returns over a 20-year average, it does not beat the market every single year. There are years when the formula underperforms the S&P 500. There are even multi-year stretches, sometimes 2 or 3 years in a row, where the magic formula underperforms. Now, imagine you are a portfolio manager at a major investment bank. If you underperform the market for 2 years in a row, your clients will panic, pull all their money out of your fund, and you will be fired on the spot. This is what Wall Street calls career risk. The system is not designed to maximize long-term wealth over 10 or 20 years. The system is designed to protect the manager's job and secure their annual bonus for the next 3 months. Because of this short-term pressure, no professional money manager can afford to stick to a system that requires patience. Instead, they are forced to chase whatever speculative bubble is currently popular, piling money into hyped-up tech stocks at the absolute peak of the market. Furthermore, the stocks that the magic formula actually selects are stocks that no human being wants to buy. When you run the formula, the top 30 list is filled with deeply unpopular, heavily criticized, and downright boring companies. It is filled with businesses going through temporary crises, suffering from regulatory crackdowns, or being dragged through the mud by the media. And that is precisely why they are so cheap. To buy these stocks, you have to actively buy what the rest of the world hates. You have to put your hard-earned dollars into 30 ugly, widely criticized businesses and ignore the constant panic on the news. 99% of human beings simply do not have the emotional fortitude to do this. They panic, abandon the formula at the absolute worst time, and fall right back into the losing retail crowd. Joel Greenblatt's magic formula is not just a mathematical system. It is a mirror that reflects the ultimate weakness of human nature. The stock market is a highly sophisticated machine designed to transfer wealth from the emotional, the impatient, and the overly complex to the cold, the patient, and the disciplined. The 40% return was not achieved because Greenblatt was smarter than everyone else. It was achieved because he was willing to be disciplined when the rest of the world was hysterical. And he understood that in the game of extreme wealth creation, a simple mechanical system executed with absolute, unyielding discipline will always triumph over a brilliant mind paralyzed by fear.
Tap to subscribe. Watch more untold stories next.